In every market crash, the same thing happens repeatedly. People panic, they sell at the worst time, and later on they say, I should have hodled. We blame the emotion. But that's not the reason why investors fail in a bad market. Because in a 25% crash, something interesting happens. And the difference has nothing to do with intelligence, experience, or discipline. So what separates them? Well, it's definitely not the discipline. It is the structure. Today, we're going to stress test 5 different portfolio structures and ask one important question. Which one is going to survive in a real economic crash and which one is going to break? Same crash, 5 investors, 5 completely different outcomes. Let's get started. Now, it's important to note that we're not analyzing personality. We're analyzing the actual balance sheet and responses for these 5 structures with 5 different risk design. The first one is 100% broad market equity. This is very simple. You basically own S&P 500 or the equivalent ETF like VOC. You're going to hold that for the long term because you believe in the economic growth that is going to drive your return. The second one is a concentrated employee stocks, also known as sometimes RSU. So basically you work at a company, your company pays you partially in a stock or maybe bonus, and most of your net worth is tied to that company because you get the income and as well as the equity bonus in form of the compensation. The third one is a classic 60-40 medallion portfolio, 60% stocks and 40% in high quality government bonds. The goal here is not to maximize the return, but it's basically to make your portfolio stable. The fourth one is high allocation crypto, 50% or more in digital assets like Bitcoin, Ethereum, Solana. So you're going to accept the maximum volatility for an asymmetric update. And the final 5th one is leveraged real estate, rental property, which is funded by a mortgage or credit line. Income is going to help service the debt and you're going to get the benefited from the appreciation. So these are the 5 structures. Now let's define the failure. So what really is a failure? Well, in my mind, the failure is not the big drawdown that happens in the market because the drawdowns can recover as fast as they could happen sometimes. Failure is when the structure of your assets is forcing you to sell that asset. Not because you want to, but because you have to do it in a market condition. That to me is a structural break. So here are our stress test scenarios. The first one is S&P 500 falling 25%. The second one is large cap tech falling 35%. Increase in volatility, credit is going to tighten and layoffs are going to increase. Now let's see when you apply these stress to your portfolio. So first, your 60-40 portfolio, what happens to it? Well, the stocks falls 25% because it's a 25% market crash. Now, if you had $600,000 in equities, that will become $450,000. But because you have the 40% in bond, which in fact rises 5% sometime in bad market, your $400,000 in bond is now going to become $420,000. So the total portfolio is going to be about $870,000. That's roughly a 13% decline. Yes, it definitely hurts, but it's not forcing you to sell because you don't have any leverage, you have full liquidity of your assets, and there's no structural issue here. Your structure is fundamentally bending, but it's not breaking. Let's look at the 100% equity. In this case, the market drops 25 to 30%, so your $1 million in the equity becomes $700,000. Well, psychologically, it's a very uncomfortable position, and I completely understand that. But it's completely liquid. There is no leverage. You're not forced to sell at all. You can continue to hodl it, and you're going to survive the market crash. Well, let's look at the concentrated employee stocks, or RSU. Now, this is where it gets very interesting. Your company stocks apparently dropped 35% because that's the same sector that has been hit by the market crash. The layoff is going to start hitting your sector. So your paycheck and your portfolio are both risks and they both decline together. So if you lose your job, where does the liquidity come from? Well, this is how smart high income professionals go from being a paper millionaires being forced to sell in one specific quarter. To me, that's not the market volatility. It's actually a correlation risk because your income and the asset that you own, they're both tied to the same company. And that's where the structural fragility starts to appear because your options are now disappearing and you have very limited options left, which is basically to sell your asset. Let's look at the high allocation crypto. 60% drawdown in crypto is very natural and sometimes it could happen in days, if not hours. It has severe volatility. But if there's no leverage, there's no lender involved. If you're not dealing with perps, then there's not going to be any margin calls or refinancing risk. So yes, you're going to suffer losses, but nothing is going to force you into liquidation. The same asset, but a different structure, and is going to continue to survive. Finally, what happens with the leveraged real estate? Well, this one, at the surface, it may look like, well, real estate, it's going to be very stable, right? Guess what? The properties, they don't reprice daily basis, but the stress hit very differently in the market crashes because the credit tightens. And when the credit tightens, the refinance becomes extremely difficult. So imagine you own 3 rental properties. The 2 are refinanced with a variable debt because you thought that that would be the best thing to do when the market was really good. Now, what's going to happen, the rate starts to rise, the cash flow is going to sink because some of your property could end up being vacant. The bank could tighten their standards and your refinance is going to fall through. Now, what do? Well, if you rely on a short-term financing or lines of credit, the lenders can reassess the collateral. So you're faced with a decision, but you don't have any control on that decision, which is to sell the property in a weak market. Ouch, that's going to hurt because you're going to end up being defaulting on your loan. This is the first structure that's actually going to break in a bad market. Not because real estate is bad. I mean, I like real estate. I invest in it because the leverage and illiquidity is going to meet the credit crunch. So let's test it out and see what happens if historically this is being applied. So let's look at the 2000 market crash when the technology market collapsed in the dot-com burst. So employees were paid in stock. They saw their portfolio and income fall together at the same time. That's a structural failure. In 2008, housing market collapsed. Short-term funding froze, which led to refinancing options being vanished. And people were forced to sell their asset at a very low price, sometimes even at a deep discount. In 2020, COVID market crash, unleveraged investors endured the volatility because they were not using any margins, but the people who were using margins, they were liquidated. So what we see that the history keep repeating the same lesson. The structural weakness is going to determine your survival. So what actually breaks the portfolio? Well, now we're going to zoom in, not only just the market, but let's look at the balance sheet. There are 3 things to remember. First is liquidity mismatch. Now, what do I mean by that? Well, long-term assets funded with short-term obligation. So in 2008, when S&P 500 fell about 57%, the national home prices fell roughly about 27%, but most investors weren't wiped out by the price itself. They were wiped out because the refinancing options disappeared. Second is called callable leverage. Well, margin loan require minimum equity thresholds, and the broker, they can actually raise the requirement during the volatility. So if it's a bad market, you're at the 30% threshold, they can say now you have to be at 10%. So when the equity falls below the level, positions automatically get liquidated. The third is income correlation. So if your paycheck declines when your portfolio declines at the same time, the liquidity disappears when you need it most. So you don't need all 3, but the 2 is often enough to maintain your portfolio rigidity. So what can trigger potentially these failures? Well, here's what most people, they underestimate the risk. In crisis, correlation starts to increase. When the liquidity starts to dries up, even in the treasury market crash of 2020, the banks, they start to tighten the lending standards during a downturn. So when the liquidity disappears and the credit starts to tighten, at the same time, the prices starts to fall and your structure becomes weak and ultimately it collapses. It was not because the market dropped, but because the financing stopped. Now let's address some of the common questions or obligations that people may have. The first one that I often hear is, but leverage actually maintains wealth and millions are made using leverage. Yes, in the rising market, I would agree with that. The question is whether the structure is going to survive when the liquidity is going to contract. The second objection that I always get, well, crypto is great because it will immediately come back, and we have seen in the recent market changes. Sometimes yes, but the recovery speed doesn't matter if the liquidated during a drawdown. So if there's a drawdown, and let's say if you're using a perp, then you can get smashed. Real estate is a safer stock. That's the other one that I heard. Often, yes, real estate is better than stock until the refinance risk becomes binding. Another one that I hear is bonds, they failed in 2022. Well, yes, that was an inflation shock for sure. The purpose of the balanced portfolio is resilience during market crisis. It is not based on outperformance of the market. So every structure, what we have noticed, it has trade-offs. Higher returns usually require more leverage, more concentration, or less liquidity, whereas higher resilience is going to require the opposite. There's no way that you can maximize on both. So then the question is, how do you audit your own portfolio for structural risk? Well, I would recommend pause the video, go through these questions and apply to your own portfolio, because theory is useful, but we want to make this practical. So here's a simple way to audit your own portfolio. You need to ask 4 key questions, and there are some underlying sub-questions for each one of them. Do I have a callable debt? You need to be very specific. Do you use margins to buy your equity or cryptos? Do you have a line of credit that is secured by investments? Do you depend on short-term refinancing? Do you have balloon payments, which is going to be due very soon? If the market is going to fall 30 to 40%, can a lender demand a repayment from you? Well, if the answer is yes, then you, my friend, have a structural trigger. The margin loans, for example, allow the brokers to liquidate the position if the equity falls below the required level. The second question is, what happens if my income drops? Now imagine the income falls like 30% for 12 months. Could it be because of the layoff or bonus cuts, or it could be because of the business slowdown? How many months of expenses do you have in liquid assets? If the income and the portfolio decline together, like the example of the RSU, do you have to sell the investment to fund your living expenses? If so, then you are in the high fragility area. Because forced to selling does not always necessarily come from lenders. It can also come from your own lifestyle. The third question is, how liquid is my portfolio really? What percentage of your net worth can you convert in cash in a matter of days? Real estate is valuable, while private equity may perform really well, and so as well the concentrated stock position like RSU may have upside. But if you cannot assess the value during the stress without taking a large discount, so if you're forced to sell in a bad market, you're going to sell at a cheap discount. So if more than half of your portfolio is illiquid and you have a short-term obligation, the structure is going to require scrutiny. The fourth question is, if the market falls below 40%, do I have to sell anything? Well, this is, in my mind, is the ultimate test. Not because it's an emotional or mindset game, but because it is the structure. So run a scenario on paper. So let's say if the market drops by 40%, does a loan covenant get triggered? That's very important. Does the margin requirements get activated? Does the cash flow turns negative? And finally, does the refinancing becomes mandatory? Well, if nothing forces you to act, you're structurally resilient. But if something forces you to act, then you have identified a weak point in your portfolio. That is a very important and valuable thing for you, because weak points can redesign before a next crisis or market crash appears. If you cannot answer these 4 questions clearly, you have hidden fragility in your portfolio. Now here's the uncomfortable truth. Most investors, they optimize for expected return. Like we all want the return to go up and our portfolio to build. but very few optimize for structural survivability. And that's what I'm positioning here right now. By compounding is only going to work if you stayed hodl and invested in that asset for the long term. And staying invested in the asset is not willpower. It's not actually mindset. It's eliminating mechanisms that can remove your choices. So you need to design for survival first, then optimize inside the structure for the long-term gain. Some of my final thoughts are volatility. I know it can be very uncomfortable, but structural fragility is fatal. Before asking what will outperform the next year so you can go invest in it, you need to start by asking, where can I be forced to sell if the market crashes? You cannot control the market, obviously. You're not going to be able to prevent the downturn. They're always going to be here, but you can design your structure so that the volatility does not remove your choices, because compounding only works if you survive. Think in trade-offs.